The irony of this world is that we all want to own and, if circumstances allow it, never owe. That's true, especially in business. Many business owners want to have assets and not shoulder liabilities, yet assets and liabilities are like the opposite sides of a coin. In this video, we will be explaining all you need to know about assets and liabilities with examples in simpler terms. So if this sounds interesting, don't forget to hit the like and subscribe button. Also, please don't forget to share with others in your network. Let's start by defining what an asset is. A company's assets are everything it possesses. Assets are a company's resources and can offer them future financial gain. Assets have economic value and can help a company's operations, enhance a company's value, or boost a person's net worth. Personal assets are those belonging to an individual, whereas commercial assets are those belonging to a corporation or enterprise. Assets can be classified as tangible or intangible. Vehicles are tangible assets since they are physical objects that can be touched. Intangible assets are resources that do not have a physical existence but have a monetary value. Some examples are brand recognition and copyright. Again, any help or goods utilized to produce cash flow, cut expenses, or give future economic benefits to individuals, governments, or businesses is an asset. The most common types of assets include fixed assets and current assets. You must know that a company with many assets is financially dependent, and we will soon explain the reason behind this assumption, so stay with us. Liabilities, on the other hand, are the debts or obligations owed by a company that must be paid. Liability is the money a company owes or the products and services it must provide. In simple terms, liabilities are all of the debts that a company owes, both now and in the future. The total liabilities entail short-term liabilities, also known as current liabilities, and they must be paid in 1 year. Long-term liabilities are also known as non-current liabilities due in more than 1 year. There are also contingent liabilities, which are liabilities that should be paid only under certain conditions. The obligations mainly stem from the money you owe, the items you must provide, or the services you must provide. You must understand that assets and liabilities are two of the most critical components of a corporate financial statement and balance sheet. We will soon explain what a balance sheet is, what information they contain, and why it's essential to discuss assets and liabilities, so stay with us. Furthermore, to give you a literal sense of what assets and liabilities are, imagine you want to start a restaurant and have an amount of $2,000, so you borrow $1,000 from a friend to add it up to your $2,000, making it $3,000. So here, the money you borrowed is your liability because it imposes an obligation on you to pay it back. But the money you initially owned, that $2,000, is your asset because it's yours. In other words, everything that belongs to a company and it's controlled by the company is an asset. Every other thing helping a company but imposing a financial obligation is a liability. The difference between your assets and your liability is equity. Equity is the net worth of a firm and is the same as capital. Positive equity is preferable, and the larger the number, the better. A negative equity number indicates that the company is in jeopardy, and that action is needed to reduce liabilities and enhance assets. Thumbs up to this video if you prefer to run a company whose assets outweigh its liabilities. Moving along the line to talk about some examples, you have to have a clear overview of some assets and liabilities. There could be an instance where a car can be both liability or an asset depending on how it's being used. Is it bringing you money or it's taking money away from you? If it's taking money from you, then it becomes a liability, but it bringing like using it for an Uber or taxi, then it becomes an asset. At this point, we want to give you example assets to help you understand what assets are. The best short-term asset is cash. A corporation with solid cash reserve assets obtains financial freedom to react rapidly to setbacks. Intellectual property can be a valuable asset in the long run. A corporation with strong patents and copyrighted material is likely to be successful. Real estate has the potential to be a highly adaptable asset. With time, real estate tends to appreciate. When a firm owns its buildings, it has a source of future money if it decides to sell the property. Machinery is a capital asset that depreciates over time. Although it is considered a company asset, it worsens with time. These depreciations can be claimed as tax deductions by businesses. Further examples of assets include vehicles, land, buildings, clients' relationships, company reputation, cell phones, and furniture. Not all, but liabilities are found in every aspect of a company's operations. Examples of liabilities. Payment of loans is long-term liabilities. Applying for a business loan has a monetary benefit since it provides short-term liquidity. On a balance sheet, however, these loans are shown as long-term liabilities. Annual income taxes are a one-time liability. Taxes are paid every year. They are, by definition, short-term liabilities. Unearned income can be a liability. A short-term liability is created when a company's income statement indicates a revenue shortfall. Companies plan for a specific level of annual cash flow, and when revenues fall short of expectations, they become a liability on the balance sheet's right side. Other examples of liabilities are salaries owing, interest payable, lawsuits payable, insurance payable, and lease agreement, among other things. In addition, liabilities reflect a net loss in value, whereas assets indicate a net gain in value. A conventional accounting calculation pits a company's total assets against its total liabilities, and investors can use the asset-to-liability ratio to determine its value. The total assets are presented on the left side of a basic balance sheet. Different forms of liabilities, both short-term and long-term, are listed on the right side of the balance sheet. According to Investopedia, a balance sheet is a financial statement that reports a company's assets, liabilities, and shareholder equity. The balance sheet is one of the three core financial statements used to evaluate a business. It provides a snapshot of a company's finances, what it owns and owes, as of the publication date. If you own a company or plan to own one someday, would you like it if your liabilities overshadow your assets? Let's hear your thoughts in the comments section below. Moreover, a corporation should have more assets than liabilities to have enough cash or readily convertible assets to pay its debts. If a business's liabilities exceed its assets, it will be unable to pay its debts and classified as financial hardship. Liabilities, on the other hand, aren't always bad because they can assist a business expansion. For example, a business might take out a loan to buy new tools. These resources will aid in the operation and growth of the company, which is a positive thing. The key is to ensure that liabilities do not outpace assets. All businesses have assets and liabilities. As a business owner, you need to know your assets and liabilities, and we hope this video provided you with the exact educational content you needed. If it did, then share it with any of your friends who might be interested in learning about assets and liabilities, and don't forget to subscribe to this channel as well. Thank you for watching. We will see you soon in the following videos. We have 3 links in the description below for more follow-up info with details. If this information was helpful to you, please like, subscribe, and hit that notification bell so you won't miss out on any new information to come. Also, please share this video as others in your circle may be interested in financial knowledge as well. Thanks for watching.